Let's take a look at one more example from Chapter 1. This one is a little different than the others we've looked at because we're starting off with some beginning balances. So in this story, the law firm has been operating for 1 month already. So on 1/31, you have some balances. Cash is $12,000, accounts receivable $4,000, and so on. If an accountant were to see this, first thing they would do is probably make sure that the assets equal the liabilities plus the owner's equity. And what I have done in this problem, over to the right in column K here, I have a little formula that asks whether the assets equal the liabilities and owner's equity. You can see that that is true for every transaction, but nothing has happened yet other than the transactions in January. So over here on the right, we've got the first transaction for February. Clark collected cash of $1,500 on account. So we're going to say the cash went up by $1,500. And the other thing that happened is accounts receivable went down by $1,500 because we are just collecting some of those accounts receivable. When I enter that transaction, of course, that's going to change the cash balance. You're going to notice down below I've got some financial statements as well, and these are automated. So you'll notice that we are still in balance on the balance sheet, but cash, which started with a $12,000 balance, is now up to $13,500. And the accounts receivable started at $4,000. It's now at $2,500. Okay, so we're going to walk through these transactions quickly. Clark purchased supplies in the amount of $5,000 on account. So the supplies go up by $5,000. That's right here. And the accounts payable is also going to go up by $5,000. All right. If you take a look over here, I'm still in balance. I've got an OK under that A equals L plus OE. Third transaction, Clark purchased equipment for $3,500 cash. Let's find our equipment account. And for transaction 3, equipment goes up by $3,500. And let's see, that was paid for in cash, so the cash has to go down $3,500. So that's a negative in the cash area. We are still in balance. Got a couple of expenses here. Transaction 4, he paid the rent in the amount of $1,000 cash. So when you incur an expense, that's a decrease in owner's equity. So rent expense brings you down in owner's equity by $1,000, and that was paid in cash, so a subtraction in cash of $1,000. Still in balance. Kind of a similar situation with advertising expense. It was $1,500 also paid in cash, so take off $1,500. And the advertising expense, a decrease in owner's equity, and a decrease in cash of $1,500. All right. Now we have some revenue in transaction 6. The revenue is $20,000, so that's an increase in owner's equity. Some of it was in cash. Total of $12,000 was in cash, so cash goes up. And the rest of it was on account, so accounts receivable goes up as well. We are still in balance. Last transaction, Clark withdrew $1,500 for a family outing, so take off $1,500 in owner's equity, and your cash goes down also by $1,500. All right, something I wanted to show you here is how we derive the financial statements. We always start with the income statement. It's over here on the left, and the revenue is from transaction 6 here, $20,000. In fact, your entire income statement comes from this last column here. It's column I on the screen. And Both revenues and expenses are owner's equity accounts, so that's where you get your entire income statement. Net income, $17,500. Right, now we construct our owner's equity statement. We start with our beginning capital, and that's going to be the very first figure up here under Clark Capital, $17,000. And if you look at the very bottom, this is where we're going to end up at $33,000. In the actual owner's equity statement, we start with the beginning capital. We add in the net income. Here's the net income over here, $17,500. You get a subtotal, add those two together, $34,500. Subtract the withdrawals that were made, and the withdrawal was in transaction 7. That'll give you your ending capital. The balance sheet is quite easy. You look at the bottom of the table and pick up your balances. These are the ending balances at the end of February. So cash ends at $18,000. Accounts receivable $10,500. Supplies $8,000, and $18,500 for the equipment. Total assets $55,000. Over on the right-hand side, again, the bottom figures for the balance sheet. Accounts payable $7,000, notes payable $15,000 for a total liabilities amount of $22,000. We know the assets equal the liabilities plus the owner's equity, so $55,000 in the assets is equal to $22,000 in the liabilities plus the ending capital of $33,000. So these two figures must match the total assets and the total liabilities and owner's equity. And if they don't, something's wrong. I sketched out for you a cash flow statement. And the cash flow statement, if you go over to the cash account, you're just going to use the cash account for your cash flow statement. And so, for example, we received cash from customers in the amount of $13,500, and that was from transaction 1, that was $1,500, and from transaction 6, where we earned revenue and $12,000 came in cash. Same thing is true with the investing. We purchased some equipment for $3,500, and that was transaction 3. You'll see a minus $3,500 in your cash. Under financing, there's only one financing transaction. It's the owner taking cash out of the business, transaction 7. Operations represents the cash that came in from operating the business. It's easy to remember. In other words, it's from trying to make a net income. Investing is where we're buying or selling equipment or buildings or other revenue-generating assets. Financing has to do with money coming in from the owner as an investment, or the opposite of that, withdrawals by the owner. All right, so one of the important things to remember here is that if you do have beginning balances, check to make sure your assets equal your liabilities plus your owner's equity before you go anywhere with it. And then the ending balances down here also must follow the balance sheet equation, because that's where you're going to get your balance sheet figures. All right, that's a little more comprehensive example for Chapter 1 and some good content there on your 3, make that 4, financial statements. All right, thanks for watching.